Alright, hey, what's up guys? Scott here again with a brand new video. In this one here, we're going to talk about a few things. Number one, the US second quarter GDP number came out this morning, and it's now the second quarter in a row where we've had declining economic growth. So this means, of course, we're now in a official technical recession here in the US. We're also going to talk about the Fed's decision to raise interest rates yesterday by 75 basis points, and then ultimately how these two things together, along with inflation, could possibly create a pretty disastrous situation in the near future. Now, as always though, before we dive in here, make sure you guys watch until the end of the video, because at that point, I've got a very cool limited time opportunity for you all that does expire in just a few more days, where you can receive up to 10 free stocks, and each stock could be worth up to $2,500. And also here, for anybody who would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. So make sure to check out the description of this video below, because I do have a link to a separate video that will tell you guys all about that Discord and discuss the main features and benefits, and also a link to my sign up page where you can join and begin your 7-day free trial. And finally here, for anybody who is brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright guys, so now getting started here, and first off, we'll take a look briefly at this article, which, as you can see in the title, GDP for the US in this past quarter, Q2, has fallen by 0.9% on an annualized basis. And this news here is definitely a bit shocking, because if we come down here, you can see that the expectations for this GDP number were actually that the US economy was supposed to grow by a pace of 0.4% at least. And so bottom line here, like I mentioned earlier in this video, this means we are now in an official recession here in the US, which is basically defined as 2 consecutive quarters of declining GDP. Right, so for example, if I scroll down a bit more here, you can see in this line right here, the first quarter GDP was also a decline of 1.6%. So I guess the one piece of good news here is that the second quarter decline in GDP was not nearly as bad as in Q1, so perhaps we could be on the way out of this small recession. Maybe Q3 has positive growth, but also the Fed, of course, is still continuing to raise interest rates. And so now at this point, if we come over to this tab, you can see this second article, which covers the basic highlights of yesterday's Fed FOMC meeting. And also, funny enough, the Fed's decision to raise interest rates by 75 basis points sent stocks absolutely soaring yesterday. Right, so in fact, if you come down here, the NASDAQ in particular had the biggest rally since November of 2020 and rose by over 4% on that news. And also there was some good news as well around some earnings announcements. But still, a 4% increase in a major index in just one day is pretty darn unprecedented. So why was the market so bullish on this increase of rates by the Federal Reserve? Well, according to this article here, you can see it pretty plainly right there. Basically, the best guess as to why stocks rallied so much yesterday is that generally expectations that the most aggressive of the Fed's actions to raise rates is now possibly behind us. Right, so at this point, we've seen 2 back-to-back FOMCs, 2 back-to-back months basically, where the Fed has raised the federal funds rate by 75 basis points, or 0.75%. And this has not happened since the early 1980s. And in particular, you can see right here that it was mostly during Jerome Powell's press conference, which I did not watch, but he must have said something very encouraging, because investors and economists saw the outline of a central bank set to ease off the gas pedal in the coming months. So again, whatever Jerome Powell said during yesterday's conference must have very strongly indicated that the largest of these interest rate hikes are likely behind us. So of course, that does not mean that in the next FOMC we're not going to see any rate hikes. It just means they might be a lot smaller, perhaps only 50 basis points or 25 basis points, but likely not a full 75. And I personally am pretty inclined to believe that fact, because if we take a look at the bond markets, which are really the true powers that control interest rates, the Fed, of course, has control over the federal funds rate, but it mostly just tries to play catch up with what the actual bond market is doing. So for example, if we come over to Thinkorswim real quick and take a look at TLT, this here is an ETF which tracks the 20-year treasury bonds in the US. And specifically here with the chart, the one thing you must know about the relationship between bond prices, as shown here with TLT, and interest rates is that they have an inverse relationship. So in particular, as bond prices go down, interest rates go higher. And then conversely, as you can see here in recent times, as bond prices go higher, interest rates go lower. So take note, for example, that the bond prices have stopped falling back in mid-June. Right? So basically at this point, the entire bond market has said interest rates have risen high enough, and now in recent times, interest rates should actually back off and come down a little bit, possibly because there are new fears about a worsening recession. So this here demonstrates very clearly what I mean, that the Federal Reserve pretty much just plays catch up with what the actual bond market is doing. So even though the Federal Reserve in the US is the largest central bank in the world, it still does not have as much power as the entire global bond market. So again here, with the entire bond market saying that interest rates in general should likely come back down a little bit, or at least stop rising so quickly, that's again why I personally am inclined to believe that the biggest of the Fed's rate hikes are possibly behind us, and that the next few FOMCs, we still might see some rates being increased, but definitely not likely by a full 75 basis points anymore. Now that being said though, the two very important variables that are at play here are inflation, of course, and US economic growth. And when you raise interest rates, that will impact both things. So rising rates will reduce inflation, but also reduce economic growth. So for example, coming back to this article here, as we saw earlier this month in July, inflation is still hitting 40+ year highs. We've seen no impact of raising rates on inflation yet at this point. And so ultimately here, that's why we're still very much at a pivotal and unknown area, because to be more specific, when you do raise interest rates, which has to be done to combat inflation, that will also, of course, make money more difficult, or more expensive, I should say, to borrow. And naturally, of course, how do most companies nowadays continue to grow and expand their business? They oftentimes do so by borrowing money. So for example, if some company wanted to raise capital for some purpose, they could do so by issuing more debt, or basically selling corporate bonds out to the public. And then when people purchase those bonds, all that capital goes to the company to be used for whatever purpose. But with rising interest rates, that means the loan payments the company must pay to those lenders are going to increase as well. So bottom line, this means that companies are either going to think twice about issuing new debt or borrowing money to grow and expand the business. They may just decide not to do it at all. Or if they do decide to do it, still their interest rate payments are going to increase, and therefore their overall operating costs are going to increase as well. So ultimately, in either case, corporate growth is going to slow down. So that's just one example, one way that rising interest rates will slow down economic growth in general. And that exact same concept applies to our government as well. I mean, the government in particular mostly runs on borrowed money, which is, of course, a bad thing. But still, rising interest rates means the government now is going to have to issue debt with higher loan payments, which ultimately means less revenue for the government. But of course, one thing the government can do, which companies cannot, to basically counteract this and raise revenue once again, is to increase taxes. Now, we have not seen the government do this yet, right? I'm just kind of speculating as to what could happen if inflation in particular here ultimately does not come down anytime soon. But if that's the case, right, and inflation continues to stay elevated and rates continue to rise as a result, then ultimately that's going to further constrict economic growth. Your taxes may go up as a result of that as well, which further discourages you from spending money, which then of course affects corporate profits and revenue. Those go down, and thus furthering more and more of a recession. And bottom line, one of the worst things an economy can experience is called stagflation, which is basically declining economic growth, or a recession, and also inflation. Now, of course, again, this is all just speculation. This is what could happen in kind of a worst case scenario, but we're still definitely way too early to make any strong predictions or assessments as to what likely will happen. That being said, though, the next 6 to 12 months are going to be very, very interesting, because I do think within that time frame, we're going to see how a lot of this is going to play out. If inflation does come down significantly in the near future, then we might be totally fine, and rates could stay where they are, or perhaps come down a little bit, and nothing would be out of the ordinary. But if inflation does continue to be stubborn, then we might see some of these more worst case scenarios actually play out. So either way, like I said, the next 6 to 12 months are going to be very, very interesting for sure. And so with that being said here, that's going to do it for this video. I hope you enjoyed it. But one last thing, as I mentioned, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my SKILLSHARE courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.